Everyone tells you to buy a house. Your parents, your friends, that guy at work who just won't be quiet about how much equity he has. But nobody's going to tell you the 12 things that actually determine whether or not that decision builds wealth or it's going to bury you. And I've watched first-time homebuyers, they've made the same mistakes over and over. And this question that just came in, it's headed straight for all of them. 12 things, life first, wealth second, real estate third. And here's what you need to know before you sign anything. I'm going to read the question here. Weldon, my wife and I were looking to buy our first home. We've been renting near base for 2 years and our lease is up in 4 months. Everyone keeps telling us just to buy a house, but honestly, I don't even know where to start. What should we actually know before we pull the trigger? Great question. And I want you to listen to that question, okay? So they mentioned the lease, they mentioned the timeline, and they mentioned the pressure from everyone around them, those that are advising them. But you know what's missing? There isn't a single word about their financial picture. No savings number, no debt mention, no budget. And that's the pattern I see constantly. Because most first-time home buyers, they can jump straight to the listings when they should be actually sitting down with their numbers first. Because this house, it's not just the first decision that you should make. Your financial picture is. And if you get that sequence wrong, you're going to end up in a house that you can't actually afford. So today, what we're going to do is we're going to walk through the 12 things that I wish every first-time home buyer knew. And it's organized in a way that I walk clients through. And it's life first, wealth second, and then real estate third. And I want you to pay attention to number 5 because that's the one, it's where the math changes for a lot of people, especially if you're military. Now, number 1, this is the one that nobody wants to hear. And this is check your financial picture before you look at a single house. I know, I get it. It's not exciting. You scroll through listings and you imagine yourself there in the kitchen. But what's happening here is if you skip this step, you fall in love with a house that you can't afford. And then every house that you can afford, it feels like a disappointment. So before anything else, sit down and know 3 numbers. What you owe, what you can save each month, and what you have set aside today. Because those 3 numbers, they're going to determine everything that comes after this. And if you don't know them, no lender in the world can give you a real answer that works for your life. Now here's number 2, and this is understand the true upfront costs because the down payment, that's just the beginning. And most people hear down payment and think that's a big number by itself. And it is. It's significant. And especially when you start looking at multiple hundreds of thousands of dollars for a home, 3%, and let's just use $300,000 for a home here in this case. Look, that's about $9,000. But 20% is $60,000. So the range is huge depending on your loan type. But you know what catches people off guard? It's the closing costs. So these are the fees that actually finalize the sale. You can have appraisal, title, insurance, attorney fees, perhaps your inspection processes. And those can roughly run 2 to 6% of the loan amount depending on your location and the lender that you choose to work with. So on a $240,000 loan, remember we had $300,000, we're theoretically putting down $60,000. That loan amount that you're taking out, the percentage for closing costs, that could be anywhere from $4,800 to $14,000 that you didn't budget for. And then there's the cash reserves. So some lenders, they like to see reserves, so money left in your bank account after closing. Now, either way, having a few months of mortgage payments set aside, that's a smart move. Not because anyone's trying to be difficult, but because life is going to happen. And the mortgage, that still shows up every month. So when you add it all up, the down payment, the closing costs, the cash reserves, the number to buy a home, that could be a lot more than first-time home buyers expect. So what I'm suggesting is budget for worst case scenario because it's better to have it and not need it than to not have it at all. Number 3, this is know the ongoing costs that nobody really warned you about. So your mortgage payment, it's the obvious one, but property taxes, that can change. And they often move over time. Because if the home values in your area, if they increase, your county can reassess and your tax bill, that can change with it and go up. Then you've got homeowners insurance, which your lender, they're going to require that, but that's been going nowhere but up these days as well. Then you've got potential HOA fees, and that can add a few $100s each year as well, depending on the type of neighborhood. And if your down payment was less than 20% on a conventional loan, now you're paying private mortgage insurance, so something known as PMI, and that's on top of everything else. And here's the one that actually surprises people the most, and it's maintenance. You're no longer calling a landlord when something breaks. That's on you now. So the roof, the plumbing, appliances, landscaping, a common rule of thumb to use is 2% of your home's value per year. So setting that aside for maintenance. And that, of course, depends on the age of the home itself. But again, on a $300,000 home, that is $3,000 to $6,000 a year. And when you stack all of this up, the monthly cost of owning a home, that's significantly more than the mortgage payment by itself. And if you don't plan for that, you're going to end up house broke. And that's where you own a home, but every other area of your life, it's a financial struggle. Nobody wants that. And here's number 4. So that's understanding the difference between pre-qualified and pre-approved, because they are definitely not the same thing. Pre-qualification, that is step 1. So a lender, they're going to look at your basic financial information and they're going to give you a rough estimate of what you might be able to borrow. It's quick, it's easy, and it's not binding, meaning it's not a guarantee. So then the pre-approval, though, that's where the lender actually verifies your income, your debts, your assets. They actually pull your credit, and that gives you a much more accurate picture of what you can afford. And most agents and sellers, they're not even going to consider your offer without a pre-approval letter. So the part that most people miss, and this is important, just because you're approved for a certain amount doesn't mean that you should spend that amount. A common guideline is keeping your housing costs in a comfortable range of your income. I like to use a rule of thumb about 25 to 28%. Your approval number and your safe number, those are not the same things. If you choose to go too high, you're in house broke territory. And I've seen families where a PCS comes with a pay bump and they immediately max out their approval. And then one unexpected expense puts them underwater. Again, nobody wants that. Number 5, this is the one that I said that you definitely want to pay attention to. And this is knowing your mortgage options. Because the loan, that right loan, that changes everything. You've got a fixed rate loan, right? Where your interest rate and your payments, they stay the same for the life of the loan. It's predictable and it's easy to budget. And then you have adjustable rate, which are sometimes called ARMs, where the rate that can actually change after an introductory period. And your payment, that goes with it. It goes higher. It's harder to plan around because it's dependent upon rates at the national level. You also have FHA loans with lower credit requirements, but mandatory mortgage insurance. You've got conventional loans with more flexibility, but typically higher down payment requirements. And then if you're a veteran or active duty military, you've got a VA loan. And this is where the math really changes, and it changes dramatically. If you qualify for a VA loan, and most veterans and active duty service members, they do, you're looking at a 0 down payment. And so on a $300,000 home, that's $60,000 that you are not pulling out of your pocket compared to a conventional loan. And of course, with a VA loan, there's no monthly PMI the way that conventional loans have, which that could save you several $100s or more every single month. That's real money back in your budget. Now, VA loans, they're not free. There is a funding fee with it, and it's typically 2.15% with the first use and not putting any money down. But that fee, it can actually be rolled into the loan itself. And then here's another great point is, if you have a service-connected disability, which implies that you're a veteran, right, of at least 10%, well, that funding fee may be waived altogether. I worked with a young officer. They were fresh out of the Air Force Academy, and this was their first duty station. And they didn't know that the VA loan existed until we actually sat down. So he'd actually been looking at FHA loans and planning to scrape together whatever he could to get that 3.5% down and paying mortgage insurance on top of that. But when we switched the mindset and we started looking at VA loans and connected them with the right lender, it meant, for his case, thousands of dollars less up front, and then hundreds of dollars of breathing room after that, right? Every single month. That's the kind of difference that changes your entire financial trajectory. All right, number 6, this is shop around for lenders. And I mean actually shop around, not just go with the first one that returns your phone call. So different lenders, they have different styles, different rates, different fees, and different qualifications, different ways to serve you. Even a small difference in interest rate, that can add up to a significant number over the life of the 30-year loan. So it's absolutely worth the comparison. Take a little bit of time now and it pays dividends, literally. Compare banks, credit unions, online lenders, and mortgage brokers. And look at that total cost, not just the rate, but the fees, the terms. And if you're using a VA loan, this is critical. Not every lender is experienced with VA loans. And some, they're going to tell you things that they're just not accurate, or they're going to slow the process down because they don't know the requirements. So what I would suggest here is find a lender who does VA loans regularly and makes the entire experience different. And if you need one, well, that's part of what we do. I will connect you with one. All right, number 7, and this is don't let the timeline rush your decision. I get it, especially if you're military and you've got PCS orders in hand and you have a report date that you can negotiate. The timeline, it feels tight, but tight does not mean reckless. Buying a home is probably the biggest financial decision you'll ever make. And I've watched people, good, smart people, make terrible decisions because they felt rushed by a lease that was ending. And a PCS timeline or pressure from friends or family saying, you're throwing money away by renting. Well, renting is not always throwing money away. It's not a great long-term plan. It can buy you flexibility up front. And so I don't view it as throwing money away. But buying right now, if it's not right for your situation, they could put you in a bad financial position. And sometimes the right decision is absolutely to wait. And that's something not everyone in the process is incentivized to do. They're not incentivized to say that out loud. And I had a client last year, they were looking during a PCS. They found a house, they fell in love with it. And on day 3, I told them, walk away. Overpriced by $30,000 in a neighborhood with declining values. They were frustrated with me. But 6 months later, they found a better house for $60,000 less, and the patience paid for itself. Now, number 8, this is stop falling in love with houses. I know that sounds harsh, but hear me out. When you get emotionally attached to a property, your judgment, it goes out the window. You overpay, you overlook problems, you make decisions based on how you feel in the kitchen instead of whether the numbers make sense. I want you to treat it like a business decision. Have a checklist, what you need, what you want, what you can actually live without, ranked by priority order. And when you walk into that house, you check it against the list. Not against how you feel, because in a competitive market, those emotions, they add up. And it's going to cause you to do things that you don't want to do. And it's going to cause you to make mistakes, financial mistakes with real consequences. And 6 months later, you're going to realize those consequences and you're going to see something better and you're going to be upset unless you had stayed disciplined. Now, I don't mean disciplined like military discipline. I'm just saying you had a strategy. You went about it the right way, purposefully, and that pays off at the end. So those first 8, they covered the money and the mindset. This next section, it's where it actually starts to get practical, okay? And the number 10, that might save you more than any of these others. But starting with number 9 now, get your own buyer's agent. Don't use the listing agent. The listing agent, they work for the seller. They have a fiduciary responsibility. Their legal obligation is to get the best price and best terms for the seller, not for you as the buyer. Now, when one agent represents both sides, it could create this conflict of interest. And in some states, they're going to say you're being represented as a transaction broker, meaning they just give you fair and honest information, but they're not actually advising you. Okay, fair enough. But they can't unhear all the information that they've seen and been introduced to whenever it came to as they were selling it and getting that home prepared. So if you're military and you're buying during a PCS, this matters even more. You need an agent who understands PCS timelines and knows the BAH and can work that affordability with the lender, with you there, of course, and making sure that, again, you are set up for success in meeting the goals that you're looking for. Get those calculations right. Get someone who's handled VA loans and they know the requirements cold. That's a specific skill set, and not every agent has it. So when you find a good agent, use them. Ask every question that you can. Write them down. Ask those questions over time. And when you're sleeping at night, put it in your notes app. Keep that running note, because I promise you, if you don't write it down in the moment, you're going to forget it by the time you talk to your agent. Now, number 10, this is the home inspection. This is not optional, ever. Don't let somebody talk you into waiving the home inspection. That's what's going to give you a detailed report on the condition of the property. And that's going to reveal problems that are going to cost you money down the road. You need to know what you're getting into. And what I suggest you prioritize here, depending on which area of the country you're in, but certainly always moisture. Pests, that's a big deal. And that includes mold concerns and termites. These can be very expensive, and in some cases, they can create health concerns. So make sure that your inspector, that they do a thorough check. And if you can, stop by the house on a rainy day. Water reveals things that sunshine, it's going to hide. And here's another big one. Get a sewer scope. That's where they run a camera through the plumbing, and they're going to check for root intrusion, so tree roots penetrating the actual PVC pipe or whatever pipe is underneath the lawn, and making sure that there's no cracks or blockages. Because when those tree roots, when they hit a pipe, those roots, they always win. And that kind of repair, that can get expensive fast. And I'm talking $5,000+. So spend $100 or so, $200 to get a scope where they go from the inside all the way out to the street, because you own that pipe. But that sewer scope, that can be worth every single penny. And here's a move that most buyers, they don't ever think to check. Check the sales history. So if a home has had multiple owners who all sold within a year or two, that can be a red flag. It's not an automatic, just know that it could be. Something might be going on, and talk to the neighbors. Tell them that you're a potential buyer and ask about any issues. They'll tell you the things that the seller, they're never going to disclose. That includes what the neighborhood is like. I loved it whenever a recent client of mine, when they went and knocked on the doors and they just started asking questions. They got everything that they needed to know, not just about the house, but the neighborhood too. All right, this is number 11, and this is related to that last statement, which is research the neighborhood. So do that like it's a mission. You're about to invest hundreds of thousands of dollars here in the house. That matters. But the neighborhood, that's going to determine your quality of life. And once you close, you can renovate the kitchen. You can't move the neighborhood, though. Check proximity to the things that matter to your daily life. And that's going to be grocery stores, medical care, commutes to work, schools if you have kids or you plan to. And by the way, school districts, they affect resale value whether you have children or not. So check the public transportation, commute timelines, and if you're military, distance to that base. Check the crime rates. Be specific. Some neighborhoods, they have higher property crime than others. So just know these things and just make sure you understand it beforehand. Use reputable local and public sources. Go to the local police department site. A lot of times they'll have where their crimes are happening and the types of crimes. And use multiple sites. That's what's going to help you triangulate on what's actually happening in that neighborhood. Then another suggestion here is to check for natural disaster risk. So that's earthquakes, floods, wildfires, tornadoes. Every area has something, and it affects your insurance costs and your long-term property value. So know what you are getting into. And here's number 12. And this is my personal regret. I want you to consider a multifamily property as your first home. Just think about it. When I bought my first home, I didn't know that this was an option. I assumed that my first property had to be a single family house. And that is not true. And learning that too late, that's one of the things that I wish someone had told me. So some loan programs, including FHA or VA, they actually allow you to buy up to 4 doors. So that could be a duplex, a triplex, or a quadplex. And as long as you live in one of those, you meet the guidelines. And when you do this right, rental income can help offset your payment. So sometimes significantly, but how much, that's going to depend on rents, vacancies, and how underwriting, how they treat that income. So I worked with a client who used his VA loan on a fourplex at his first duty station. He lived in one unit, rented out the other three, and in this case, that rental income helped carry the payment while he built equity. So when he PCS 3 years later, he kept it as a full-time rental property. And that one decision at 23 years old became the foundation of his entire investment portfolio. You're not just buying a place to live. You're buying a potential investment, especially in today's world where the average homeowner, they're only in a home for 5 years. Well, you need exit strategies, options, and it pays to think about that ahead of time. And when you understand that from the start, that changes the entire conversation and your options at the end. So there we are. Those are 12 things that I wish every first-time home buyer knew before they signed anything. And notice the pattern. The first 6 were about your money and your loan options. The next 2, they were about your mindset. And the last 4, they were about the property itself. Life first, wealth second, real estate third. That's the sequence. Once you understand your life goal, you've optimized it for wealth, then the real estate strategy should complement those 2. And when you follow that sequence, you don't just buy a house. You make a decision that you can actually afford and actually feel good about. I'm Weldon Hobbs, and when we're making big decisions, we start with your life goal, we optimize it for wealth, and then we focus on the real estate. Remember, good decisions, they start with good information, and I'll see you in the next one.